Hi, I'm Rainey with Finance Strategists. In this lesson, we're going to cover
Yield is the income or return generated from an investment over a period of time. The return can be in the form of interest earned from bonds, dividends paid out by a stock, the difference between what a security was bought and sold for, or a mix of both income and appreciation. Yield is generally expressed as a percentage of the invested amount, market value, or face value of the security. The formula to calculate yield is yield equals net realized return divided by principal amount, where net realized return equals total income earned minus expenses, and principal amount equals initial investment amount. For example, say an investor buys a stock for $100 and sells it for $110 after a year. During this time, the investor earned $3 in dividends. Then the investor's realized returns are equal to the sum of their profits and dividend payments, i.e. $13 in this case. Using the formula outlined earlier, the investor's yield from the investment is 13 divided by 100, or 13% since there were no associated costs. Sometimes there are charges or expenses related to the purchase, storage, or maintenance of the asset. For example, real estate investments, such as the purchase of an apartment, generally incur property taxes and maintenance charges. Those expenses must be deducted from income earned to get an accurate measure of the asset's yield. An asset's yield can be influenced by various factors. For example, U.S. Treasury bond yields are generally inverse to the time frame of the bond. Therefore, Treasury bonds with a longer time frame to maturity have higher yields. On the other hand, yields from savings accounts offered by banks are dependent on the federal interest rate set by the Federal Reserve. A security offering high yields may not always translate to profits for investors. For example, stocks with falling prices may have high dividend yields because the stock's dividend stays the same while the stock's price is declining. Although the dividend yield may be high, the overall yield from the stock investment may be low if the stock continues to decline in price. Similarly, bonds with high yields, generally referred to as junk bonds, have greater risk attached to them since they are more prone to defaults. For a bond, yield is similar to a bond's stated coupon rate, or percentage interest to be paid by the bond, but differs because bonds trade for a different price than their face value on the open market. The yield will be higher than the coupon rate if the bond is bought at a discount and sold for its full face value, since one will invest less for the same return and will keep the difference between the discounted price and face value when the bond reaches maturity. Let's hear from you. Would you prefer to invest in an asset with low but consistent yields or a volatile asset with high yields? Leave your answer in the comments below.
For more information, visit www.financestrategists.com. Finance Strategists, strategies for your future.